So good afternoon, everybody, and welcome. Welcome to people here in the room with us in London. Welcome to the people online or on the call. Of course, in the room we have here Henri Decastre, Denis Deverne, and Gérald Alain. And without further ado, I'll hand over to Henri.
Thanks, Andrew. Good afternoon, everybody. It's a pleasure to be here once again, especially when it's for commenting what I think are pretty strong results. So, where do we stand? I think you will agree with me that the first half is showing a very strong growth in earnings. It's true for underlying earnings, up 11%. It's true for net income, up 25, and it's true for adjusted, which is a basis for dividends, up 8%. If you look at the underlying earnings per share, it's up only 6%, not that much because the number of shares has increased, but because there is an adverse foreign exchange effect. If we were to adjust for the Forex, EPS would be up 9%, which we think is a pretty good performance. I mean, both 6 and 9 are good performances because, as you see, they are extremely well aligned with the goals of Ambition AXA. We have been delivering on the selectivity front, which is one of the pillars of Ambition AXA. Some of you had expressed worries at the end of the first quarter on the possible growth on the life side. We told you at the time that we had some non-repeated exceptionals or exceptional elements, and that we were pretty confident that we would be positive at the end of the year in terms of APEs. I think this chart is illustrating what we were meaning. There has been a significant acceleration in APEs in the second quarter, where we are up 8%, which for the half year is leading to a stability, but with a very strong momentum built in during the second quarter. And this is not to the detriment of the margins, as you see. Sorry. Since margins have improved by 2 points when compared to last year. So overall earnings, underlying earnings in life are up 200 million, which we think is a pretty good achievement. If you look at the property casualty, first point, portfolios are growing, which we think is something interesting because it's not the case everywhere and for everybody. Revenues are up 2%. And if you look at the combined ratios, the current year combined ratio is down, which is a good achievement given the fact that the amount of natural catastrophes, especially in Europe and especially because of the hailstorms of the second quarter, have not been insignificant, and this is an understatement, and Denis will elaborate on that. Underlying earnings on the P&C side are up 100 million. So on the first two pillars, life and savings and the property casualty, strong growth in earnings. We have accelerated in the high growth markets, and this is reflected in the earnings, which are up double digit, both in life and P&C. And we were willing to illustrate here operations which for us are pretty significant because we think that they have a very large growth potential going forward. By that I mean our two operations in mainland China. The joint venture with ICBC, which has become the first foreign venture in China, where APEs are up 21% when compared with last year. 46 million can seem to you as being, well, a number not that high, but if you look at the revenues of that venture now, it's 900 million euros for the semester. So it's not a negligible operation. Second point, AXA Tianping, which is the most recent acquisition, with the idea that with the number of cars bought by Chinese people, And with the potential of the Chinese direct insurance market, it was the right time to do it. Revenues are up 30% when compared with last year, and the amount of direct business has grown from 20 to 30% of the total. So the plan is working according to what we were expecting. Cost savings. Two elements there. The first one is we have pocketed 200 million of additional efficiency savings during the first half. Second point, we increased the target for the end of 2015 by 200 additional millions. I will remind you that we started this plan with a goal of 1.5 billion, which we then increased to 1.7. We now bring it to 1.9 because we think we have the means to reach this number before the end of last year. This does not mean that we are not going to invest in the future because, as you know, we will have invested approximately 800 million in digital between 2013 and 2015. What does this all mean? Well, it means that what you have in front of you is a business model which is performing well in a low interest rates environment because we have taken management actions to make that happen. The diversification of the business mix is reducing the earnings volatility, and I think this has been underestimated by the market. 70% of group underlying earnings are coming from P&C and protection and health. The second point is, I think, our strong ALM discipline with a less than a year duration gap is paying off. Third point, we have decreased the sensitivities of the group or the sensitivity of the group to a low interest rates environment, which doesn't mean that we would not benefit from an increase in rates in the US. And I think this point is a point which also has been underestimated by the market and is now proven right by the earnings of this semester. So what does this create going forward? We are pretty confident that we will deliver on the underlying earnings growth targets as defined by the Ambition AXA framework, 5 to 10% over the whole period. We have told you that the goal was to realize 300 to 500 million of capital gains every year. It's something we confirm. Last but not least, and I know this is a topic of particular interest to some, if not most of you, the dividend. The dividend. The dividend. I have now to very precisely remember what we have agreed to say with Gérald and Denis. And what we have agreed to say is very, very simple. First point. The key driver of the dividend growth should be the growth in earnings. And as you see, earnings have been growing strongly in the first half. Adjusted earnings will remain the basis for the growth of the dividend. Second point, we have a payout range for the dividend which is 40 to 50% of the adjusted earnings. We are not going to change the range, but we are going to very respectfully make you observe that we are at the very bottom of the range and that I've never said that we would forever stick to the bottom. Full stop. Denis.
Good afternoon. I thought that Henri was in such a great shape that he would do the whole presentation himself. So, moving back to the financial objectives of Ambition AXA, Again, we are in line, and I'm on slide A11. Underlying earnings per share at 1.08 euro. So we are confirming that we have a compound annual growth rate of 6% so far. Nothing to say on the free cash flow at the half year, but we are in line with the objective. Adjusted return on equity was for the first half at 16.8%, above the range of 13 to 15. And debt gearing was, like at the end of last year, at 24%, well within the range of the new range of 23 to 25% that we have announced at the beginning of the year, our previous guidance being 25%. Now looking at the underlying earnings in more details, you can see that the underlying earnings have grown by 11%, that we have a growth in each of our business segments, with the exception of asset management, which is at -4%, but would have been at 11% if we take into account the disposal of AXA Private Equity, which took place in the fall of last year. Moving to the next slide, and you have here a waterfall of the underlying earnings comparing the first half of 2014 to the first half of 2013. You see that we have a very substantial increase in our life earnings, 198 million, and this is taking into account the minus 30 million of lower contribution in the US coming from the loss of the money assets, 105 million in P&C as a result of the and we'll see as a result of the improved in the investment yield and the increase in premium. International insurance also positive. You see that we have more holding expenses with further investments in the brands and digital. And we have adverse effects of Forex, which is largely coming from the depreciation of the Japanese yen. Adjusted earnings up 8%. We have both slightly lower capital gains, 439 million euros compared to 555 last year, but also much lower impairment at 91 million euros. And that gives us the adjusted earnings of 3.1 billion. So the net contribution of capital gains is slightly lower than last year. Net income up 25%. This is related to the change in fair value of derivatives, both fixed income derivatives and Forex derivatives. We had a negative last year coming from the increase in interest rates. We have a positive this semester coming from the decline in interest rates, and a slight negative on Forex coming from the Japanese yen. We have lower exceptional and discontinued operations, but still some negative coming from Hungary. We have lower integration and restructuring costs. Last year we had a significant cost coming from the restructuring of our real estate footprint at AllianceBernstein. We don't have this year. And we have a similar level of intangible amortization, in total plus 25% at 3,008 million euros. Moving to the life and savings part, first on the new business. New business was down 1% in mature markets. This is largely related to the fact that in the Q1 we had we had two things. In Switzerland, we've reduced the amount of the volume of group pension new business in the first half of this year. Last year was a big year for group life. This year we have decided to reduce the volume of new business because this is a business that has relatively high guarantees. And we have also had a very significant one-off in terms of health new business coming from the move to the unisex tariff in Germany. Other than that, the momentum that Henri has mentioned in Q2 also applies to mature markets. The margin has improved 1 point to 31%. High growth markets, the growth of new business was 7%. It was up 12 in Asia, but we continue to suffer from a decline in Central and Eastern Europe, which is largely related to Poland, where we see the end of the impact of the nationalization of pensions, which has continued to materialize for us this year compared to last year, where we still had in the first half some positive contribution on the pension side, which have disappeared at the end of the first half of 2013. Margin has improved from 45% to 48%. We have solid growth in Asia, as I mentioned, with good growth in Hong Kong, in China, in Thailand. In total, flat new business volumes and improvement of 2 points of the margin during the first half. Looking at it from a NBV margin and net flows by business, protection and health continued to be the highest margin business at 55%, with the continuation of nice net flows at 4.3 billion. And we had a slight decline in production, which is largely related to what I mentioned in Switzerland and Germany. General account savings, we saw a rebound of new business, plus 9%, largely related to France. NBV margin at 13%, but still net flows negative at minus 1.5 billion. And finally, unit-linked 29% margin, a growth of AP of 2%, a net flow which is slightly negative at minus 0.1 billion. But this flow has suffered from 1.1 billion coming from the success of our GMXB buyout in the US, which closed in January, with the exception of New York, for which we had the authorization later and continued later in the year. Moving to the next slide, pre-tax underlying earnings by business, plus 11%. On the protection side, we have a growth of 8% with better claims experience in France, higher fees and revenues, and higher expenses in line with the commercial activity. On the GA savings side, we have higher technical margin coming from higher positive prior reserve developments also in France, higher investment margin reflecting lower crediting rates, and slightly lower fees and revenues as the assets come down. Unit link was up 11% with higher management fees in line with higher asset base and a lower technical margin, which is again mortality in the US on the variable life side. I'll move now to property casualty with a growth of revenues of 2%. The growth was 1% in personal lines with an average price increase of 1.7%. The point to note is that we had both more than 300,000 net new contracts, as mentioned by Henri, average price increase of 1.7%, and only 1% of revenue growth, which means that we have lower average premiums coming from a continuation of the financial crisis and people trending down in terms of the coverage that they ask for. Commercial lines was up 3%, average price increase of 2.2%, revenue growth being driven by tariff increases and volume increases, particularly concentrated on high growth markets. Looking at the usual slide of A23, where we show the price increases by market, price and volume increases by market, you see that we had still more green than amber on this slide. So we've been able to put in price increases almost everywhere, and we see no price decline at this stage. Pricing trends for the second half are slightly less positive. They remain very positive in France. They are more subdued in the other markets, but we don't see significant price declines, with the exception perhaps of Italy on the motor side, where we are in the second year of price declines. On revenues and margins by markets, mature markets had revenues up 1 point and current year combined ratio down by 0.5 point. High growth markets had revenue growth of 5%, lower than usual. Asia was up 8%. Our Mediterranean and Latin American region was up only 4% because of both Turkey and Mexico, which showed less. I mean, Mexico, we have a decline of our exposures because we saw some price competition coming this year. And the combined ratio was up 20 basis points from 97.3 to 97.5. Also, difficult market conditions in Turkey and Mexico. The Gulf has very good results in terms of growth in the Mediterranean region, and Asia also very good results in terms of growth and profitability. Direct was up 7%, and the combined ratio slightly down by 0.2%. In total, our current year combined ratios continues to improve to 97.1, very close to our target of 97 of our Ambition AXA plan for the current year combined ratio. In total, the P&C earnings, underlying earnings went up 9%. You see on the flow chart on the right side of the slide that we had positive elements in terms of price increases and lower expense ratio, but negative elements in terms of higher claim severity and higher net cat charges, of which 241 million for the Hela hailstorm, which hit France, Belgium, and Germany in June. In total, our natural catastrophe charge was 1.7% for the half year compared to 0.7% for last year. We have slightly lower positive prior year developments, 1.3 points against 1.8, which leads to a stable all-year combined ratio at 95.8. You see a very good performance of our investment income, up 12%, in yield of 4.2%. It would be 4% if we excluded the exceptional mutual fund dividends in France, which amounted to 67 million euros and are probably not repeatable across several years. Moving to asset management, we have a good story on asset management with net flows of 14 billion against 12 billion last year for the same period, 11 billion at AXA IM, 3 billion at AllianceBernstein. What is notable for AllianceBernstein is that they were negative in the first quarter, and they had more than $8 billion of positive flows in the second quarter, so we see a sharp rebound at AB. Revenues were up 7% at AXA IM. This growth of 7% takes into account the sale of AXA Private Equity, and revenues were up by 3% at AllianceBernstein. In total, the asset management earnings went down 4%, or 11% excluding the AXA Private Equity. The decline was 15 at AXA IM for the reason I have mentioned. It would have been +9 without AXA Private Equity, and we have a growth of 14% at AllianceBernstein. I'll hand over now to Gérald for the balance sheet, and I thank you very much for your attention.
Good afternoon. So let's move to the shareholders' equity. The shareholders' equity went up from 52.9 to 58.9 billion euros. On the right-hand side, as usual, you have the various movements, the key drivers of change. I will comment only the most important one, which is a change in unrealized capital gains, mainly driven by lower interest rates, and the sub-debt plus 0.8, corresponding to the 1 billion undated subordinated debt that we issued in May 2014. Moving now to the debt gearing. The debt gearing is at 24%. The Total net debt is more or less stable at 12.4 billion. The debt ratio is at 24, so within the 23 to 25% range that we updated, that we fixed before we were at 25. Interest cover is improving from 10.2 times to 11. And I would like to mention that Moody's and Fitch changed from a negative to a stable outlook. So that means that we are the equivalent of AA minus stable at Moody's and Fitch and AA plus stable at S&P. Moving to the economic solvency, the economic solvency ratio went up from 206% to 215%. You have the roll forward, so this increase is mostly explained by the operating return of 12% for the 6 months. We have a minus 3% adjustment coming from the markets, and mainly, as you can see in the upper right, coming from the decline in the interest rate. So we are continuing to work with our group supervisor on the validation of our internal models. This includes looking at the latest developments in the Solvency II framework. What I can say is that we don't expect any of these impacts to create an issue for us and for our capital. Asset liability management, we have a general account invested assets of 489 billion. The global asset allocation didn't change significantly. You can see that our fixed income asset duration remains very long. As explained previously by Henri, we manage roughly a 1 year duration mismatch, which means that in life and savings we are at 7.2 years and in P&C 5 years. This long duration explains why we have a slow yield dilution. We are at 3.7 in life and savings, and you have we started in 2010 at 4. In P&C, same. We are at 4.2, but excluding this exceptional mutual fund, as explained by Denis, would have been at 4%. This slide is quite interesting. It's, as explained by Henri, we have a resilient margin. And here what you can see on life first in the upper part of this slide is that although we have a progressively declining asset yield, the fact that we have very low average guaranteed rate and on top a declining average guaranteed rate makes that we have a safe gross margin of 150 bips, which means that we have a resilient investment margin, which was at 79 bips in the first half of this year, well within the guidance of 70 to 80 bips. As far as P&C are concerned, we have resilient yields, and which makes that in the end we have a resilient investment income. Let's have focus on the net amount invested during this first half. We invested 22 billion at an average rate of 2.9%, of which the Eurozone is at 3 billion. Where did we invest? Mostly, of course, it's our business in fixed income, but more in investment-grade credit rather than in govies, and also in some diversification. And as you can see, most of the investment-grade credit in corporate bond, but some part also in commercial real estate and other loans. I hand over to Henri.
So, if we sum up, what would we like you to take back from this afternoon's session? Strong increase of earnings across the board in the three big pillars. Top line growth on track in life, in P&C, in asset management. The company is performing well in a low interest rates environment, and we are comfortable that we will deliver on Ambition AXA objectives. If I look forward, what are the priorities? Keep delivering profitable growth, keep accelerating the growth through investment in brand and digital, because we think these are two things. We are at a time where the world is changing, and investing in brand and digital is susceptible to move market shares. we will maintain a very strong discipline in capital and risk management, and we will offer you an attractive dividend. Having said that, we will move to the questions. Who is going to ask the first one? Well, maybe we'll start from the bottom of the room. Go ahead. If you could stand up, say who you are, and ask your question.
Okay. Peter Elliott from Berenberg. Probably won't surprise you to start with a dividend question, maybe, but I guess after the full year results, you commented that we should probably expect the lower end of the range for the next few years, and you were very careful in your wording earlier. But I think I managed to pick up a small improvement in the tone, and I was just wondering if perhaps you could touch on why, or the reasons perhaps for that tone increase, whether it was sort of the better, the very strong half-year result, or perhaps the factors that fed into that. Secondly, on the APE comment, I guess the surprise for us at the first quarter was the change in strategy in Switzerland and sort of not offering the full solutions. I noticed that in Q2, the Swiss numbers were up quite strongly, Q2 on the previous Q2, and I was just wondering if there was any change in that strategy in that country. And then perhaps thirdly, if I may, just on the Mediterranean and Latin American region in P&C, Denis, you gave some figures there, and in particular on Mexico and stuff, but just if I take a headline sort of top view of that, I guess we had some quite significant action in Turkey sort of 12 to 18 months ago, which hopefully would have sort of improved that result a little bit there. In Italy, we've had a very profitable market, which has sort of probably been improving. I guess I was slightly surprised to see a combined ratio still quite close to 100%, with still some additions. I was just wondering if there was any more granularity you could give over the different countries within that region. So,
Denis, do you want to take Switzerland and the Med region?
Yes. So Switzerland, there was no change in TAC in Q2 compared to Q1, but Switzerland, we have both group business and individual business. The group business is quite lumpy, as you know. It's a business that is, I would say, discussed in Q2 and goes on the book Q1 of the following year. So basically, the campaign of 2013 led to the Q1 figures of 2014. And what happens in the other quarters is essentially individual business. So we had a very strong individual business in the second quarter. It has nothing to do with this policy change that you referred to on the group side. On Med-LA, I'd like to make two comments. First, on Turkey, we had a negative surprise in 2012 where we strengthened our reserves quite significantly because of a very dramatic change in bodily injury claims trends, with a trebling of the bodily injury awards by the courts. And we thought that we had dealt with it once and for all, and this it emerged that it was not the case, because for two reasons. The courts have continued to, I would say, change the jurisprudence in a way that was more favorable to the claimants, and the claimants can go back 10 years. And we had been a big writer of a third-party liability in Turkey with a very high market share. So we continued to have some negative developments in 2013 and even early this year. We have increased prices between the fall of 2012 and the spring of 2013 by a total of 50%. The market did follow us last year, but we saw some of our competitors early this year that started to reduce prices, and we have lost exposures as a result of that. But our current year combined ratio in Turkey remains quite good. We still have a little bit of negative developments, less so obviously than in the previous years, but our current year combined ratio is good. But the new news for this year is that at this stage we are slightly losing market share. The comments that were made on Med-LA were focused on the emerging market side, and Italy is not part of that that bit of medley. Italy is classified in the mature markets. I mentioned Italy as a country where prices have come down. They've come down 6% last year. They are still coming down this year. We were starting from a very strong position, and our position in Italy in terms of combined ratio remains quite solid. So we are not worried about this position.
On your favorite subject, yes, there is a slight change in tone. Why so? Earnings are strong in the first half. We are confident that we will deliver on Ambition AXA. And the reason for which we were more cautious was the fact that there's a number of uncertainties regarding the discussion surrounding Solvency II and CFIs was such that we thought it was good and prudent policy to be cautious. The more we come closer to the outcome on Solvency II and to more visibility on what's going on with the CFIs discussion, well, the more elements we have to adjust our position. So I've said what I've said. I'm not going to repeat it. But I'm sure you've noted it. Next question. Yep.
Thank you. Good afternoon. François Boissin from Exane BNP Paribas. First question, if you could come back to the 100 million euro negative sensitivity that you have with interest rates. What's the methodology behind that? That's the first question. And second question is, with regards to the GSII legislation you just mentioned, maybe just an update on where you stand on this one and how you see your US operations in this context. And just the third question is, with regards to Solvency II, what areas of your internal model are you likely to recalibrate according to new legislation? Thank you.
Okay, good. These are great questions for Gérald.
Okay.
It's his I mean, these are his two favorite subjects. So.
Okay, and the 100 million euro sensitivity, what we did is something quite simple. That means that you notice that I mentioned that the new business, the new investment for the first half was 22 billion. So roughly we invest, let's say, 45 billion in new money, of which, let's say, 80% is in fixed income. So assuming that we would, starting from something around 30 billion invested at minus 100 basis points, that makes 300 million minus tax, minus PB, because a significant part goes to the policyholder, makes that roughly you have 100 million. What are the areas on, that we are, on which we are working? I would say that first we have the capital on sovereign, we have the fungibility, we have the volatility adjuster, we have the ultimate forward rate, all these type of elements, you know, which are changing, but as I said, that means that in the end we are confident, but for the time being it's not stabilized yet.
You want to say a word on GC fees?
So I may take the GC's discussion. Gérald commented on Solvency II. Well, there is still a lot of unknown, but there is one element that has been clarified, which is what is called the basic capital requirement, or BCR, where we don't have a final regulation, but we have a draft that has been put out for consultation by the IAIS, the International Association of Insurance Supervisors, at the beginning of July, and the calibration that is proposed for the BCR is in line with what had been indicated informally by members of the IAIS, which means that for European players, it comes in the area of 70 to 75% of the SCR. So they have delivered what they had said they would, and so far, I would say, so far so good. It doesn't say anything about two important topics, which are the quality of capital and what they will say about the quality of capital, and the factors that they will take into account for the HLA, which means higher loss of solvency, so the parts of the business that they consider as more systemic. So we still have this, an expectation that this We'll have more information about this by the end of this year. But I would say so far, so good.
Okay. Nick, you had a question, I think? Sorry.
Nick Holmes at SocGen. Yeah, two questions, please. One is on emerging markets. I think about 13% of your underlying earnings come from high growth markets at the moment. And I wondered if you could share with us your sense of where this might develop, say in 5 years' time or whatever time period you think is appropriate. Second question is looking at expense reduction. Your P&C expense ratio has come down to 25.9%, and you've achieved 1.3 billion of cost reductions. I think in P&C, correct me if I'm wrong, but you were targeting 1 billion of expense reductions. And my question is, what effect do you think, firstly, where are you with that 1 billion on the P&C side? And then secondly, if you were to achieve the 1 billion, what might that do to your expense ratio, which is currently around about 26%? Thank you.
On the first part of your question, and I'll ask Tony or Gérald to take the second one. On the first part of your question, remember, I mean, back in 2007, I think the amount of earnings coming from the emerging markets was around 5%. Being at 13 is already a significant growth. What we expect, of course, is to have it continue to grow double digit. There are some of these businesses which are in their infancy phase, so it's going to take some time. If you take the Chinese P&C business as an example, because we invest heavily on it, I mean, it's profitable this half year. It's better than what we were expecting because, in fact, we were expecting to have some losses because we are investing in the development of the business to create portfolio value and to create volume. But over time, I would say that it's not unreasonable to have a target of above 20%, 25% of the earnings coming from the emerging market in the foreseeable future, before a change in the decade, I would say. On the second question, Gérald, do you want on the P&C expenses?
On the P&C expenses, I would say that roughly we are 2/3 of the objective of 1 billion, which means that just for you to make it clear, it's 0.3 billion represents roughly 1% of combined ratios. That gives you a flavor of what it could mean.
Yeah, Farad.
Hi there. Just actually, you didn't answer part of Nick's question, which is, how much is left of the expenses in P&C. But so that's question one. But question two is, you also gave a range of remittance ratio a long time ago, and then I believe the sense was that was also stuck at a fairly low level, because you're rebuilding capital, blah 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 blah. And now we're in a better environment. Are there initiatives that you think will make that appreciably better? Because I know that some of your competitors are looking at this and very focused on it. So that's question 1B. And
you go to 25.
I mean, if you go to 5C, it's going to be a pretty long question. Go ahead.
And the other question is, if US interest rates ever go up, long-term yields, if they went up by 100 basis points or they went up by 200 basis points, what's the IFRS earnings impact, both sort of immediately and then after 2 or 3 years? Thanks.
Gérald, you want to take
Yes, on the remittance ratio, I would say that
the expense ratio first. The expense ratio on P&C. What remains to be obtained?
yes, but I answered.
Well, I understand that Farouk wants the end of the answer. So my understanding is that Gérald has given the end of the answer, which is, since we have realized 2/3, there is still 1/3 coming.
Yes, I'm sorry, it was implicit for me, but.
2/3 plus 1/3 makes the world.
And roughly speaking, I'm sorry, Farouk. Roughly speaking, I said that it could be roughly 1 point. So that's the answer. And on the remittance ratio, I would say we were at 75% last year. We are doing all what we can in order to improve this ratio. What we can expect is so long as the US are improving, you can see that the contribution from the US significantly improved. We could have some reimbursement of debt coming from the US, so that would be a plus compared with what we did last year. Your last question was on the IFRS impact.
But maybe on the remittance ratio, one additional point is that in continental Europe, we, on the life side, we see all the regulators who are taking into account the lower interest rates in Europe to push for an increase in statutory reserves with a reduction of the discount rate. So this is a headwind that we have on the life side in Europe. We'll try to compensate that, as Gerald said, with other measures, but we have this headwind coming from the continental European supervisors on the life side.
The last part of the question was on the increase in interest rates in the US, if it becomes very significant and its IFRS impact.
Of course, in the US we have this, I would say, first of all, if rates are going up in the US, that means that we will have less reserves because the options will be less in the money. So there will be an improvement. It's difficult for me to give you a precise measurement of what it would mean, but look at the difference that we had today. We still have, I would say, I believe that it would be 100 million roughly. We had 100 million pre-tax, pre-DAC of impact when we have a rise of roughly 100 basis points. But you have to take into account the fact that if rates are going up, immediately we will amortize more DAC. So the impact would be, let's say, roughly 40% of this. I can give you a more precise estimate, but that's roughly what I have in mind.
And we have also a positive impact of an increase of the short end of the curve on the US, because here we would get a positive carry that we don't have, that we had assumed in the reserving initially, and that we don't have. So we would benefit from an increase in short-term interest rates on top of the benefit that we get on the long end of the curve.
But there is a back book effect eventually because you feel that your reserves are too high. But that doesn't happen immediately, automatically, does it?
No. Let's be cautious on that side. What you are referring to is the fact that at the end of 2012 we decided to increase the reserves corresponding to the policy LDR behavior. Nothing tells me that if rates would go up by 100 or 200 basis points, we would have to decrease these reserves. It will depend effectively on the behavior of policyholders, and nothing tells me that they would have a different behavior. So let's remain cautious on that side. What I described previously was really a technical factor coming from the fact that we would benefit, in fact, from a higher level of interest rates.
Next question, in front.
John Hocking from Morgan Stanley. I've got three questions, please. Just to come back to the comments on capital and the dividend. If I sort of remember rightly what you said at the full year, you absent earnings, you basically said the macro environment was pretty tricky. There was uncertainties around Solvency II, and there was uncertainties around SIFI buffers and global capital. If we sort of unpack where we are now, the global macro is, if anything, tougher, both sort of politically and also with interest rates, with yields coming down. On the SIFI side of things, we have some clarity on BCR, but we're still nowhere near knowing where the HLA will end up. So implicitly, are you saying that Solvency II has ended up in a better place vis-a-vis what you're expecting? Because that seems to be the only piece which has changed. That's the sort of first question. And then second question, on acquisition costs, the extra 200 million, I wonder if you could break down where you think that's going to come from and whether there's any sort of knock-on impact on growth. And then just finally, when do you think you're going to get internal model approval from your lead regulator?
Okay. I thought you had three questions. You said you had three.
It was capital, acquisition costs, and then the internal model.
Okay. On your first question, don't try to do too much Kremlinology. Yes, we are more confident about Solvency II. We are also more confident about CFIs. On the first point, yes, the global environment, as far as interest rates is concerned, is tougher. On the other hand, it's not improbable that US rates will start to go up. And more than anything else, if you look at the way the group is behaving in a tougher environment, both in terms of revenues and in terms of earnings, we have some reasons to think that the model is working well.
So on the SIFI, the extra confidence on the SIFI, where are you getting that confidence from? Because I see the BCR's landed in a good place.
I'm not telling you that the discussions have come to an end, but on BCR it's reasonable. On the rest, we will see. It's going to be a long process. At this stage of the discussion, we are not saying it's going to be easy, but we think it's not going to be disruptive. Next question.
So the other two questions.
Yeah. Sorry. Yeah. Sorry. Yeah. The two other ones.
So your question on acquisition costs was where are they going to come from?
The extra 200 million. So what's giving you the confidence to do the 200 million additional?
Because we have. It's always the same. We start from a top-down ambition, and then we try to reconcile that with a bottom-up plan. And we have very precise bottom-up plans in our various operating units that give us confidence that we will achieve those figures. And you asked for the source of those expense reductions. I believe that in the slide that Henri has presented, we mentioned on the right A7 sales support, productivity improvement, marketing efficiency, commissions optimization, which means commission reductions, and these are the sources of those 200 million. On the internal model approval is your third question. Where do we stand? We stand in a reasonable place. It's a huge and complex process which involves not only the French supervisor but the supervisors of all the European entities. There is a college of supervisors. They gather on a regular basis. We have meetings with them and they look at the internal model bit by bit. They narrow down the number of questions that they have. We are supposed to file a pre-approval in December. We're supposed to file a final approval at the end of May. And we believe that we are on track to meet those deadlines. And everyone on the regulatory side seems to work towards the deadlines as well.
Andrew.
Afternoon, it's Andrew Queen at Autonomous. A slightly fluffy question. The development of digital is presumably so you can interact with your customers more. And in interacting with your customers more, you'll have to be more transparent with them in terms of what you charge them to sell them the products. And that sort of is underpinned, I think, by regulators around the world, including some of the MiFID II stuff. Could you give us a sort of pencil sketch as to which markets you think could be most challenging in terms of greater transparency around distribution costs and sales costs?
So probably the mature markets before the emerging ones, which doesn't mean that some of the emerging are not going to be sensitive. But if you look at the consumerism in this market, in some of the other European countries, these are places where you will have to be more transparent. We don't think it's long term. We don't think it's an issue because we think that if properly handled, digital can enable you to very significantly improve the service you give, making it much more comfortable with the customer, and that therefore we do not think that this is a major factor in reducing the margins. You will have a portion of the business which will become more transactional. The automobile business, it's clear that for traditional agents it's going to be a tough life. But if you can reskill them, or if they have the proper skills, they will do more of the commercial risks where the market is under-equipped. And the consumers will still keep having automobiles and will need to insure them. And we are pretty well positioned with the direct business.
In addition,
but I think the most of the pressure will come probably in the mature markets first, Denis, what would you
I
add
just
to
wanted
that?
to add that we have also some of the markets that we qualify today as high growth, like Hong Kong, where we see the regulation changing rapidly, and I mean it will impact us on the unit-linked side because traditional products will not be impacted by this transparency initially. It will be an impact that will focus on the unit-linked, and there is certainly going to be a market impact of this move to transparent commissions next year. So it's coming in different shapes or forms. I mean, you've seen India 3 years ago that was hit by that with the change in regulation. So it's it's not directly connected to digital. There is clearly a move towards more transparency, more commission disclosure, more disclosure of charges, which is affecting many of our markets gradually, and we need to be ready for that. And I believe that at the end, we must be on the side of the customers and be in favor of those changes.
Just as a follow-up then, how do you get ready for that in terms of selling life policies when you're in such a low interest rate world in terms of actually cutting the charge structures?
And that, I mean, you've seen our program of expense reductions of now 1.9 billion. This program takes into account the need to reduce the expenses of the business. And when we are at the end of our 2015 plan, our next plan will also include a reduction of expenses, because we believe that we are in an industry where the charges are excessive, and they will need to get closer on the life side to what is happening on the asset management. So we need to continue to reduce our expense base.
Yep.
Hi, it's Ralph Hepken from KBW. Just two things. One is on the US variable annuity book. I wonder whether you can give us some sort of commentary on what the profitability of the legacy VA book might be. Best would be an answer like it contributes so much in underlying earnings, but I'll leave it to you what metric you might wish to choose. And the second question is something which we sort of discussed already. It relates to the regulatory environment in Europe, but specifically to Germany. I wonder whether you can give us a view of how you feel new regulatory legislation in Germany might impact fungibility of capital and cash upstreaming capacity in your group. Thank you.
Do you want to answer the first question?
Yes, maybe you can go in your booklet, for those who have the booklet, on page B26, and you have an update on where we are in terms of USVA legacy book. And you can notice that we have for the first half a contribution of 123 million euros, slightly up compared to last year, but we had some positive one-off last year. You can notice that anyway, the hedge margin is at minus 35, which means that taking the basis risk, the volatility risk, interest rates, they have decreased a lot. So that means that we have been doing a lot in the last years in order to decrease the basis risk, being much more indexed. The volatility went down, but we have also been managing some through options ways to lock this volatility. So that's it, and you can see that now we can expect that as far as the variable annuity book is concerned, that in the absence of much higher market conditions that would worsen a lot, we are at a relatively stable level now. And what we can expect is at the same time, going to the previous question, in case the markets would improve, then of course we will have an improvement and a gradual improvement of the fees. Last but not least, out of the 431 million of life and savings underlying earnings for the first half, keep in mind that we improved pre-tax basis, the fees that we extract from the unit-linked business improved by 63 million, which is quite substantial. And this is also the benefit of this of the improvement in the equity markets.
On the first part of your question, and Denis will add something if he feels he need. I think he has already given a portion of the answer. On fungibility and on the reaction of the regulators, it's not only in Germany that you see the tendency of regulators to try to put their hands on more capital if they can. It's a case in the UK, it's a case in Belgium. It's a sort of game before they all jump into the sea of Solvency II. So they are trying to force the players to increase their local buffers. It is what it is. I don't think it changes the world. It's unpleasant. It's difficult discussions. If it were to persist beyond, it would be a problem because it would mean that under the appearance of a common system, you have very different behaviors. But I think it's a sort of normal regulatory fear before the introduction of a new system. Denis, do you want to add something specifically on Germany?
No, I would say that the German reform has some positive aspects and some negative aspects. From a profit standpoint, it's not negative, but from a distribution standpoint, it looks rather negative. So yes, it's one of the headwinds that I have mentioned.
Do we have another question in the room? Okay, go ahead. And then I'll check if we have questions. No, we don't. Okay, there is one here.
Hi there, thanks. Paul Diath from RBC. Just a quick question on life products. You mentioned a few times in the release the success of the hybrid products, the kind of general savings and unit-linked products. These were also mentioned by one of your peers yesterday as a success story for them. Are these the answer to the issue with Continental Life sales, or are they just a kind of a ways and means to get everyone into unit-linked products in the long term as you kind of scale back the guaranteed savings element and increase the unit-linked? I mean, how do you see these going forward?
Yeah, I mean, good question. It could be a bit of both. I mean, we are in a situation where it's not very rewarding for clients to invest for the long term in general account products if these products are invested mostly in bonds, even if historically the performance has been good. And we all know that most of the time small investors, when investing, they look in the rear mirror. So it's not in their interest to be totally exposed to general accounts. So what we try to do, because it's also in our interest to see them buying unit-linked, if they don't want to jump 100% to unit-linked, it's to have this sort of hybridation. So I guess the answer is probably it's a bit of both. Any other question? Yes? Blair, and then...
Thanks very much. Blair Stewart from BofA Merrill. Just picking up on a couple of things. I think it was Allianz who took a reduction to their economic capital to reflect the possibility of sovereign default risk. Just wondered what your comments on that were. Secondly, on expenses, when you get to the end of your Ambition AXA plan, where do you think your expense level will be relative to your peer group? Have you done any benchmarking exercises that you can share? And thirdly, I think one thing you've talked about in the past is the quality of capital. You know, I think Denis mentioned that the business was still in deleveraging mode, and I guess that was to improve the quality of the capital. I noticed you've pre-funded some debt retirements with some Tier 1 hybrid. There's quite a lot of debt coming up over the next few years. Just wonder if you can say anything about the quality of the capital of the company, because the quantity of capital looks very strong.
Okay, very good. Gérald, do you want to take the first and the third part of the question, and Denis, do you want to take the second one?
About the sovereign default, I could say that we can expect that nothing is settled yet, but that we can expect that for those who will adopt internal models, there will be some capital in front of sovereign, but in front of spread risk and not credit risk. At the same time, we should keep into consideration the fact that there will be some what we call the volatility adjusters. That means some mitigation mechanism that will offset at least part of this. The second, the questions you raised, the question about the quality of capital. Yes, you are right. That means that what we have been doing is that we have been anticipating the 0.8 billion maturity of a senior debt that will mature in September, and we have issued a Tier 1 debt. Why? Because we took the opportunity of very good market condition. We did it at 215 basis points spread, and at the same time, as you know, we'll benefit from the grandfathering over 10 years. And if you refer to page 31 that I just presented, you can notice that now all our debt, which is at 12.4 billion, all our debt is either in undated subordinated debt or in subordinated debt. So that means that it's a very high quality debt, and it will qualify for Solvency II.
Maybe one additional point here. Some of you have asked us whether we expected to reduce our debt gearing to below the current level. We are mindful on one hand of the quality of capital, but we are also mindful on the other hand of the efficiency of capital, and we want to use all the space that is available within Solvency II to have Tier 1 and Tier 2 debt that qualifies for capital, and we don't think it would be good for the shareholders that we end up underusing the ability that we have to have a Tier 1 and Tier 2 debt to fund our capital if it is allowed under Solvency II. So that's something that we are very clear. So we might retire the remainder of the senior debt that we have. We don't intend to reduce the amount of subordinated and deeply subordinated debt that we have on our balance sheet. On the expenses versus the benchmark, it's certainly a moving target. When we launched Ambition AXA, we had the ambition to be above the peer group in terms of, better than the peer group in terms of expense ratio. But I believe that we are not moving alone. We talked earlier in the discussion about the pressure to reduce expenses, the increase in transparency. So I expect that by 2015 we'll be probably at the benchmark or slightly better, but not so much better. And we believe that we will have to continue to reduce our expense base going forward.
And so we already know that in the plan which is going to follow Ambition AXA, you'll have a significant piece devoted to expense reduction. Next question. Oh, 3 of them. Good.
Hi, François Boissin again from Exane BNP Paribas. Just a follow-up question on your European strategy in Belgium and CEE. Belgium, it seems that you're losing market share in P&C. So just maybe just some elements there on what's going on in Belgium. And in CEE, conditions have become tougher. You've exited from some markets. So just how you believe your operations are going to be positioned there. And then just finally, you mentioned the plan following Ambition AXA. So when can we expect an update on the following plan? Thank you very much.
To the latter part of your question, once Ambition AXA will be over. On CE, it's clearly, it has been, when we decided to accelerate in the emerging parts of the world, CE was clearly on the list. If we had to start it again now, we wouldn't put CE on the list, clearly. We have been disappointed by the evolutions in Hungary, in Romania, Ukraine, even if we have a very tiny operation there. And in Poland, with the nationalization of the pension market. If you look at where we are now, we have a stake in Réseau, which is the second largest Russian P&C company, 36%. We are happy with it. We don't intend to move that. It's a profitable company. It's a good model. It's a risk like any Russian risk. but it's a large market, and we think that it's a reasonable bet on this market. We wouldn't increase the bet, of course, under the current circumstances. Then we remain with operations in Poland and in the Czech Republic and Slovakia. The Czech Republic and Slovakia, it's a small thing. The Poland, it's a significant market. If we could expand our P&C operations, we would certainly try to do it. But it's not going to be. I mean, it's clear that Central and Eastern Europe is not going to be a major part of the developments going forward. Denis?
On Belgium,
Okay.
it is true that we've been losing market share in P&C. We did it in part deliberately because we are not happy with our profitability. And I have to say that we did it very successfully. If you saw our combined ratio in the first half, I believe that it is just under 90% all year combined ratio. Sorry?
91.5.
Okay, 91.5, sorry. So we did successfully, and we started to regain exposures in automobile insurance in the first half of this year. So I believe that we had to improve the underwriting. We changed our footprint. We were overrepresented in the south of the country, underrepresented in the north. We've corrected that. So it's been a massive turnaround that has been taking place in the last 3 years. We are happy with with the result that we have now, and we are regaining market share gradually. So there is no, there is no fatality there, and the Belgian market is a profitable market for us, and we intend to hold our own in that market.
Oh.
Thanks. Farooq Hanif from Citi. I noticed that your cash at the holding has gone up a lot in recent years. I mean, obviously you've sold businesses and there are lots of drivers behind that. But the number is just historically very, very large. And you have, as Blair pointed out, a lot of debt, and you pointed out that maybe you retire senior debt. So I'm thinking in my mind, do you have an ideal level of cash that you'd like to keep, or qualitatively? And if you felt like you had surplus, what's the best use of it now? Retiring debt, buying something, reinvesting? You never seem to talk about that. Thanks.
Gerald.
Yes. So the point, yes, we have a lot of cash, but a lot of cash explained also by the fact that we have been anticipating the refinancing of debts. Second, your legitimate reaction is to say, okay, it's an underutilization of cash. No, because when I tell you that we are managing a duration of 7 years in life and 5 years in P&C, this includes the cash. So that means that we have strategies which make that from time to time. First of all, in our business, we need to keep some part of cash. We need to be liquid. And at the same time, we integrate this in our management of duration. So that means that it's not a sub-optimization.
And we have to have some cash also, given the size of our derivatives program, both at the holding company and in the VA portfolio.
We say Miranda.
It's John Hocking from Morgan Stanley. Can I just ask a question on the leverage? So you're in the middle of your sort of leverage range, so 23 to 25%. I just wondered how you think about financial flexibility and leverage. So would you, within that range, be prepared to go above that range, or do you think you've got financial flexibility within the range? So just trying to get an understanding for it. If you had an opportunity that required you to raise debt, is there an argument for you to undershoot that range if you think 23 to 25 is the sort of optimal level to be in a run rate?
No, let's be clear. It's necessary to have some flexibility because you have up and downs. So 23 to 25 seems reasonable as a level. As explained before by Denis, of course, the cost of this debt is pretty cheap because we have been optimizing it. And look, we are borrowing at slightly above around 4% before tax. To see if we will be at 20, I cannot tell you that we will be at 23.5 on that debt and at 24.5. The range is fine. Don't interpret if we go at 24.5 or 25, it shouldn't be interpreted. That's within the right range, and the target will remain this one.
Good. On this note, if there are no additional questions, no additional question on the dividend. So it must mean that we have been pretty clear. Okay. So on this note, I suggest we adjourn. We will wish you not only a very good dividend, but also a very good summer. And we look forward to seeing you soon. Thank you very much.